So this is a macroeconomic video based on monetary policy, but more specifically quantitative easing. Now we'll just start off with a quick definition. So it's also known as QE, or asset purchases, and it's a tool that's used by central banks, especially more so in modern day economics. So countries such as Japan, the UK, the US have all used it recently, especially after the 2009 financial crisis. So it's used to inject money directly into the economy, and when it's usually used is when they've already changed interest rates, and interest rates are already very, very low, and there's perhaps little movement of interest rates. So what they've done is they've created this new tool called QE, and it involves the creation of digital money, which is then used to buy things like government debt in the form of bonds. So to understand QE, it's important that you also understand what bonds are, and bonds can be a little bit confusing. So a bond is a fixed income investment in which an investor loans money to an entity. And now that entity, it can be corporate or it can be governmental. I mean, typically the central bank will probably start off with governmental, but you never know, they might go into the corporate market as well. It depends on the rate of QE, it depends on how much QE is actually needed. So so as I've said before, it borrows the funds for a defined period of time at either a fixed or a variable interest rate. And the whole reason for it is to raise finance. So that might be the government needs finance, it might be firms need finance, but that tends to be the reason for bonds. So if the Bank of England or any central bank is looking to purchase these bonds, it's to kind of inject finance into either the government or into the private sector. So if there's a lot of demand, and this is where it gets a little bit confusing, and I have got resources based on assets and bonds. If you want them, just request. But if there's a lot of demand, the bond price will go up. Simply supply and demand. But if it goes above the face value, then what happens is the yield is automatically lowered. And what I mean by the yield is the return on that bond. So it's almost like the interest rate of that bond. And the reason for that is because the government will only pay back the face value plus the stated interest rate, or maybe the private business will. So therefore, if the face value increases, then the yield has to decrease because of the agreed payment on that bond. So for example, if for whatever reason, and this is going away from QE, because if QE took place, it would raise the bond price because of the demand for these bonds, because of the electronic money that's been injected in. But imagine if, for whatever reason, the face value of bonds fell, then the yield would then increase. So there's an inverse relationship between the two. So as I said before, the aim of QE is to boost spending investment in the economy. It's an expansionary monetary policy. And when the UK did it, when the UK started to use QE, was, like I said before, when the financial crisis took place. Interest rates were used first. They were used originally, brought down to that rate of 0.5, okay, in stages. But when it got to that 0.5%, it couldn't really go anywhere else. So they had to kind of inject money to try and help continue that expansionary policy from the central bank with regards to monetary policy. So the MPC makes large-scale purchases of government bonds, which lowers the interest rate or yields on those bonds. And this pushes down on the interest rates offered on loans, so example mortgages or business loans, because rates on government bonds tend to affect other interest rates in the economy. Now with regards to that, just remember about the inverse relationship between the prices of bonds and the yields of bonds. So just remember, with QE, the price of bonds will go up, but the yields will go down. So QE, the reason it works is because it makes it cheaper for households and businesses to borrow money. So because of that interest rate or that yield falling. And in addition, QE can stimulate the economy by boosting a wide range of financial asset prices, because again, there's that demand for those assets now. Now what you can see in terms of how the UK carried this out in terms of QE. So we can see in terms of November 2009, July 2012, August 2016, and the amount of electronic money being injected. Now, just as an example, as a hypothetical example, just to explain it a little bit more, suppose the central bank bought £1 million worth of government bonds from a pension fund, let's say. So the government bonds were within the pension fund. And in place of the bonds, the pension fund now has that 1 million in money because they've bought it and they've injected that money, the central bank has. So now that in exchange, they've got that money. So rather than hold on to this money, it might invest it into financial assets, such as shares, and that give a higher return. So then, therefore, the demand for these financial assets grow or increase or become high. So with more people wanting to buy them, the value of these assets increase. So this makes businesses and households holding shares wealthier, making them more likely to spend more, boosting economic activity. So it's almost like the wealth effect because of these assets. Because these people who had the assets before, then they've increased in value. So they feel wealthier because of the asset increase. Now, the UK are not the only country who have carried out QE after the financial crisis. As we can see here with the US, with the Federal Reserve, they also did it. So in 3 phases since late 2008, the Federal Reserve has bought trillions of dollars in bonds using newly created money to stimulate the economy. So we can see here, we can see the different stages in terms of QE1, QE2 and QE3. Now, how they did that was, we can see within this, they bought bonds in different sectors within the private industry. So we can see the electricity, consumer, communications, industrial and transport, water, and they were injecting money into all these different sectors by buying bonds that corporate bonds that belong to them. So remember, that was sourcing the finance for them. Now, my advice to you is don't overthink quantitative easing, because when you do overthink it, it does become more confusing, and it is sometimes difficult to get your head around. But at A level, all you need to remember is QE is an expansionary technique to try and electronically inject money into the economy, and the way they do that is because the central bank purchased these bonds, perhaps corporate bonds or maybe governmental bonds or possibly both.